Good afternoon, everyone. My name is Anika and I'm one of the advisors at HJP. Thank you for joining us today, and I hope you're all having a good week so far. During this webinar, my colleagues Davey, Charlotte and I want to discuss some of the things we frequently hear in our meetings from clients who are new to investing. We'll be covering some of the beliefs, the myths, the opinions and the facts about investing, and hopefully some of these may resonate with you. Investing is certainly a journey, and however you feel about investing right now is valid. Our aim is to hopefully share some ideas and concerns that we often hear, including some of the barriers that people face when saving for their future. And as usual, we welcome any questions either in the chat box on your screen or in the feedback form after the webinar. So to begin with, one of the beliefs we often hear from those who haven't invested before is, I don't have enough money to make investing worthwhile. This is often a misconception born from comparing ourselves to who we believe is a typical investor. You don't have to have a lot of savings behind you just to make a start. Even with modest sums, there's still a benefit to investing. Everyone starts somewhere. Having said this, it's important to make sure you have some accessible savings first, usually in cash for the short term and for any emergencies. We don't recommend investing money that you may need to use in the near future, and this is because some investments can fluctuate in value, which could cause you financial and emotional stress if the value goes down just when you need to use that money. However, we do meet some people with plenty of short-term savings who still feel that they don't have enough money or assets behind them to start investing. And in this case, there's often a belief that investing is only for people with many thousands of pounds or for people who are really experienced at investing, which is absolutely not the case. If you do have cash savings, it's likely that some of this could be working harder for you by investing, which really just means saving your money across different types of assets and not just cash. We know it can be intimidating when people who already invest talk about it using lots of jargon, and that can put you off even just making a start. How much money you need to be able to start investing simply depends on your own personal situation, and that could include what you're saving for, the resources that you have available for the short term and any emergencies or unexpected costs, as well as how much you could afford to save for the future and how you feel about money. And the key is to start small and slowly build up some funds for the future. If a lump sum investment feels impossible, then you could invest a small amount on a monthly basis or as and when you feel you can. And Davey will talk about this more later. You might already be investing without realizing it. For example, if you're a member of your workplace pension scheme, then each month you and your employer will be paying into a pension, which is a long-term savings pot for retirement. And a pension comes with tax advantages, and the money is invested into at least one fund, which is a professionally managed pot of money, usually spread across hundreds of different investments. If you set up a small regular direct debit to invest, this will feel manageable and you don't need to remember to invest each month. It's automatic and it's easy to do, and you'll be surprised how quickly those funds can start to build up. If you're not sure where to start, a financial advisor can help you work out how much is affordable and what your options are for investing. Davey's now going to talk about another concern that we often come across.
Thank you, Anika, and good afternoon, everybody. Thank you very much for joining us. Now, one of the myths we hear is, I'm too young or I'm too old to invest. Well, you know what we're going to say. It's never too soon or too late to start. For example, would you like to give your grandchild £1 million pension pot? Even a newborn child has a pension allowance, £3,600 per annum. And due to the benefit of tax relief, you would only need to put in £2,880. The government would top up the other 20% to £3,600. If you do that every year until the child is 18 and get, say, 6% growth a year, if that fund is then just left, or we would say managed or overseen, and that's left until the age of 60, then that could grow to over £1.25 million. Junior ISAs or JISAs could be another idea. Up to £9,000 a year can be contributed. But please be aware, at the age of 18, that fund belongs to the child, whether mum and dad like it or not. Utilising the maximum contribution every year, then at 6% growth a year, this could amount to over £250,000 at age 18. People in their mid-40s with no pension could contribute for another 20 years or so and pay in up to £40,000 a year, providing they have the income to support it. Tax relief applies to this too. Now, believe it or not, we are sometimes approached by people in their early to mid-50s with no pension. It is still not too late. Tax relief and compounding will help to build up a reasonable sum. And we then have clients in their silver years who are building up a fund as they are no longer paying a mortgage and the children have flown the nest. And this fund can be used to support them in later life or create a legacy. And it may be one of these scenarios resonates with you. And I'm now going to hand over to my colleague, Charlotte.
Thank you, Davey. So a common myth we're approached with is investing is too complicated. Many people do find the thought of investing to be confusing, complicated, and often full of jargon. The most well-meaning websites and YouTube videos can leave you feeling more confused than when you started, and news stories of cryptocurrencies and bull and bear markets is enough to make even the most financially savvy frazzled. But in reality, investing should be pretty straightforward. A simple definition of investing is the commitment of your current financial resources in order to achieve higher gains in the future. So whether you're saving for your future home, your future children, or even your future self, in even more simple terms, it's just putting your money today aside to grow for tomorrow. All types of investments are essentially saving pots for money, just with different timelines for when you can access them and different tax treatments for the money going in and the money coming out. But it's our job to make sense of this part for you. So whether you see yourself as owning properties, a second home, or even just a comfortable retirement, the chances are investing is for you. Thank you. Back to Anika.
I think I was on mute. So investing can be risky, that's true. In life, it's impossible to avoid all risk, but it is necessary to take some managed risk. For example, there is a potential risk of an accident as you commute to work each day, but it's still something we take a chance with because of the benefits of being in work. Taking managed risks can be rewarding, and without those potential rewards, those risks aren't worth taking. The main risk, which causes first-time investors to hold back, is the risk of losing some or all of your money or not being able to access it when you need to. However, if you're able to spread your investments appropriately across many different types of investments, then if something goes wrong with just one of them, it shouldn't affect your whole amount invested. This is what we call diversification, which is just another way of saying not putting all of your eggs in one basket. Your aim as an investor should be to try to maximize the amount you can make over time whilst minimizing your risk. Although there is a risk that some investments can go down in value in the short term, choosing not to invest some of your money also carries risk. This is because of inflation, which is when the cost of goods and services creeps up over time. So you don't really notice it happening each year. But at the moment, we're in a period of high inflation, and inflation is also increasing rapidly at the moment rather than gradually creeping up. If you leave too much of your money in cash, the interest you might earn over time is unlikely to keep up with rising costs. And this means that in the future, you'll be able to buy less with your money in the bank year on year because the value of it is being eroded over time, even if the amount in pounds and pence doesn't go down. For example, if inflation is 5% and the interest you've earned on your savings is 0.5%, then you've effectively lost 4.5% of the value of your savings, even though the cash balance won't look like you have. And like I said, inflation tends to creep up over time, so it's not always obvious. But at the moment, everyone's more aware of rising costs with food, fuel, energy, and lots of other things because the increases are high and they're happening quickly. For example, the average cost of a loaf of bread in July 2021 was £1.06. And if we fast forward a year, this July, it was £1.24. So the longer you leave those savings in cash, the worse inflation could affect you. Having said that, if you have money set aside to spend in the next 5 years, for example, on home improvements or a holiday, it makes sense to keep that in cash. If you're building some savings for the next 5 to 15 years, then you can afford to take a medium level of risk, which means including a blend of investment types, including maybe some shares, some bonds, some cash, and other types of investments. And if you're investing for the long term, i.e. 15 years away or more, you can afford to take a more adventurous approach to risk, as long as it's properly managed. This should mean that your funds can work harder for you, and any fluctuations in value in the short term won't be a concern because you don't need to access that money soon. You should never feel pushed into investing in something that you don't feel comfortable with or that you don't understand. Don't ever feel worried about asking questions when it comes to your money. All of the questions, even if you think it's an obvious one, just ask them. We get to know our clients and find out what's important to them, what their objectives are, and how they feel about it all. And we make sure that you feel in control, but we're there to support you as you need. Over to you, Davey.
Thank you, Anika. So another myth we come across is, I don't have the time. Now, clients say to us, I would like to do something, but I'm too busy. I never seem to have time. Either they're working and when they get home, it's tea, bath and bed with the children, or there are jobs to do, or something always seems to crop up when they have the best intentions. Sometimes people are not sure what they do have, or they don't understand the paperwork, or it is simply just too much hassle and things get put off. But the good news is we can help. We can work around you. We can do what suits you. Whether that is a chat over a cup of tea and a biscuit, a phone call, email, text, or as we're all used to now, good old Zoom or Teams. Plus, we will always do our best to explain things in English rather than bamboozle you with jargon. We can discuss what you would like to do, look at options, and put you in the position where you can make an informed choice. We never forget it is your money and how hard it is to earn it. So, why should you find the time to do something? Well, of course, you don't have to do anything. Although there is a saying, if you do what you've always done, you'll get what you've always got. It is difficult to predict the market. We don't have a crystal ball. So we feel what is important is time in the market. Now, what you're looking at now is a chart, and what this chart shows is the returns of £100,000 invested in the FTSE All-Share Index over 20 years. By staying invested, £100,000 has grown to over £231,000. It's more than doubled. But missing just the 10 best days in 20 years has almost halved the return. And missing more best days reduces returns even more. Now, maybe tomorrow might be one of those best days, or next week, or next month. But if you're not in the market, you will miss it. So maybe that is a reason to help us help you find the time. Now, one idea to find the time is to invest automatically using direct debit. And Anika touched on this earlier. This is possibly how you pay your council tax, insurance, and other things. This can be a good way to smooth out the ups and downs of the market. So let us share something else with you. This chart that you're looking at demonstrates the benefit of investing regularly. In this case, £1,000 a month. Line A shows the market going up in a nice straight line. And after 12 months, the unit price has doubled from £1 to £2. However, line B shows the market falling and then coming back. In month 2, £1,000 has bought 1,493 units. In month 2, £1,000 has bought 2,000 units and 2,500 units in month 3, and so on. At the end of the 12-month period, the unit price is back to £1 where it started, but the value of the holding is over £10,000 more. So if you feel you don't have the time, now may be a good time for us to help you. And I will now pass over to my colleague, Charlotte. Thank you.
Thank you, Davey. So a common statement that we do hear is that I already have a plan. And whether deliberate or not, the chances are you do already have a plan in place, or at least part of one. The success of any of your future financial goals is all down to the plan that's in place right now. And there are simple ways that you can ensure your plan is on the right tracks if you feel you haven't started yet. And breaking it down into smaller parts is also a good way to get that plan going. There's a few things that you can do to check your current plan and make sure that it is solid and on track, or to start the new plan that you do want to have. So firstly, running costs. Have an idea of how much you have coming in each month and how much is going out as well. That's a great place to start. Is it enough? Where does it go? Keeping a spreadsheet is not everyone's idea of fun, but most banking apps do have features now that can take the legwork out of that task. Secondly, an emergency fund. So once you know what you're spending, aiming for 3 to 6 months worth of that value is a great way to start to hold that as cash. It's not going to provide any returns, but it should be easily accessible and somewhere safe like a bank account. A good idea is to keep that account separate from your main bank account that you use day to day, and that will stop any savings getting dipped into. If you're not holding that level of cash just yet, don't panic. Most people aren't, but saving a little bit regularly will soon help it build up. Knowing your benefits is the third thing to check. So if you're employed, you might receive benefits from your employer or be entitled to benefits from the government. Knowing what these are can make you feel on track right away, and finding out from work about your pension savings and what your employer is making for you is also a great bit of information to have. You probably will have been given it when you first started your job, but put it to the back with all the other paperwork. And most people in the UK have pension pots in different places, and there's lots of pension pots of people in the UK they aren't even aware of. That retirement cruise could be closer than you think. So that's just a few starting points to help you get the plan started. But if you want any more information or chat through the plan that you already have started yourself, please get in touch with your HJP advisor, but the chances are you're already on your way. Over to you, Anika.
Thank you, Charlotte. That brings us to the end of today's webinar. Thank you for joining us. We hope you found it useful and interesting. If you have any questions that we haven't answered, please do get in touch with us after the webinar. As a final thought, it's important never to underestimate the importance of taking a small step in the right direction. Like with anything in life, small steps make it easier to start and easier to keep going. If you're not sure what your first step should be, please leave your contact details in the feedback form afterwards, and one of our team will contact you. Thank you again for watching, and we'll see you soon.